got the incredible Ray Ostrander. I'm going to just share my screen real quick, and then you can introduce Ray, Patrick. But I got to say, Ray, this presentation that people are going to get tonight, it's actually much more of a working session than it is a presentation. But this is like years in the making, right, Patrick? I remember having lunch with Ray in a restaurant that I owned before COVID, talking about him coming to the Real Estate Investment Network. And Ray's kind of a staple in the community. He's been around a long time.
He's been on lots of stages. He has spoke and educated, coached, thousands of real estate investors, not unlike the work that you and I have done over the years. But Ray did it a little quieter in a little different way. And then he went out on his journey of kind of looking after his portfolio. And that's what we're going to hear a little bit about tonight. So I'm excited to have Ray join us and be on the stage and actually share some really cool insights into multifamily world and what happens on the other side of the border. So, yeah.
Awesome. Mr. Ray Ostrander, welcome to the stage, buddy.
Thanks for having me again, guys. It's funny that you mention it that way, Patrick. I guess for a long time, I really haven't been doing a lot in the educational space. As much as I love it, and I hope we have a great discussion tonight about it, there really was that element for me in terms of what is it that's most important. And I think I mentioned last night that I was fortunate enough to have a mentor early on in my early 20s who was a former CFO of the Detroit Tigers. A successful guy from a financial background who entered into the real estate market and also was a trainer and educator as well. And, his focus for me was always cash flow, cash flow, cash flow. And that's been my focus. So these discussions that you guys have are so fantastic. And over the years, getting to know you and JG and being able to talk about the fundamentals, this was almost completely unimportant to Mike, my mentor. And what he would talk about is the importance of individual properties as they compare to their submarkets. And then he would say, all things being equal in that area, in terms of performance of that asset, now let's look at the fundamentals. So we kind of came at it both ways. And I've had the benefit of knowing you and the great work that Rain does on fundamentals and kind of pairing that with that intense discipline for deal-specific performance. So that might be a great jumping off point to just chat a bit about how we analyze things. So maybe what would be a great thing to do as well. Multifamily investing tends to be intimidating to a lot of people. And so if you're thinking about multifamily and you've been looking at it, maybe you've owned some properties, you don't know which direction to go, there are probably some areas that you have some fears about or some concerns, questions. Go ahead and just drop those into the chat box and JG and Patrick will field those and get them out for me to kind of address as we go along. Yep. Last night we looked at an example that I had done. I always like taking examples from the group because it's easy to go in and really break things down. But I do have an example prepared here. Do you think that would be the best place to start, Patrick, today?
Yeah, let's start there. Let's bring up that example. That'll get some thoughts and questions fired up, I'm sure, when you go through this. And we can give everybody a look at what you got going on. And keep in mind is that, Ray's here to share some of your maybe insight, share his insights with you in terms of what he knows. So if you got some questions, get them in the chat.
Now, last night, I just want to prepare everybody. Last night, Ray shared a spreadsheet that was so comprehensive. Some people couldn't even sleep. I was getting text messages last night, Patrick, at 2 and 3 in the morning because some people were so excited about this damn spreadsheet Ray shared. So I'm just preparing everybody for the spreadsheet that's coming up here.
I did get a couple of connections as well last night from people with questions about what we talked about, which is awesome. I mean, that type of engagement is helpful. So anything you have while this is going on, fire them in the chat box. Yep. This is about a deal that we just completed. And I want to share a bit about our philosophy on this. These tend to be B class properties. I usually like to be in C and D class. C and D class properties afford me the opportunity to significantly provide, lift to the property. The heavier the lift, the more money that we make. And it also usually means that I can get better deals. Sellers that are having distressed situations, problems with managers, personal issues that they can't get back to a property and manage it effectively, whatever it happens to be, those distressed situations open up opportunities for us to be able to force appreciation. I like to be able to force appreciation a lot more than try and predict where it's going to happen because that's left to much smarter people than myself. And I want to make sure that I'm right 100% of the time. So when I'm trying to pick markets to work in, I'd rather pick projects that are going to have that likelihood of success. So this is a perfect example of that. And it's not because it's a heavy lift. You can see from the pictures, and I'm going to show you a different property in a minute that's far worse. This property is actually in reasonable condition, but the cost per unit relative to the income, you'll see there's a lot of upside here as we get into that spreadsheet that JG mentioned. But I want you to see a couple of pictures as we look through this. Generally, a good property in reasonable condition. Do we care about location? Of course we do. Clinton Township is just sort of north of Detroit, right next to a great market sort of in Sterling Heights there. So for us, that's a great spot. Where would I prefer to be? I actually really like to be down here. And for those of you who are familiar with this market, this is not the better market. This market down here is tougher, but we get price points in and around $50,000 to $60,000 per unit. Keep that number in mind. Up here, we're closer to $90K per unit.
Now, Ray, you said 50 to 60,000. Are we talking about kitchens here? What are we talking about? Because I pay $50,000, $60,000 for a kitchen renovation, it appears. So
I know. So one of the people that reached out to me today and was asking, how is it you're able to get such better returns than other products that are available here? And why do my returns look so good? I'll give you a simple explanation for that. It's not that we have magic beans or magic properties. It's real simple math that you guys all know about. So let's say, for instance, that we're buying something for $90,000 a unit. We're buying $90K per unit, and our going in rent is around $900, and we can get that over the course of a couple years to $1,300 as our average rent. That's a huge increase in it's over 33%, close to it's a huge increase in rent. If I'm buying the same product in Ontario, I'm probably paying somewhere between $200 and $250. So I don't know, we'll call it $225K per unit. And the going in is around $1,350. Where does that increase to over the course of a couple of years? Well, as all of you know, there are restrictions in terms of what we can raise rents in certain markets. Ontario has some rules, BC has other rules, Alberta is the land of the free. So we want to look at these different areas, but if we're in Ontario, they may be only able to get this up to 14 or 14 and a quarter. They can't force the growth the way that we can in markets like Alberta or certainly the US. Most of the states, in fact, all the states that we look into in the jurisdictions do not have substantial rent control. That is not a way that we want to do business. But so people ask, how can we do better? Well, here's the answer. If we can get $1,300 for $90K a unit, or we can get 14 and a quarter for $250, you don't have to be Einstein to figure out that the math on this is going to produce far better income. That does not mean necessarily that the appreciation that comes naturally from being in the best markets is going to affect these properties. It doesn't mean that at all. But what it does mean is that I'm going to be able to drive substantial increase in the value of the property, and I don't have to rely on external factors. And I'm a control freak. I don't want to rely on external factors. So, for example, markets like Windsor, Ontario. I was in Windsor, 2011. We purchased a property for about $660,000. It was 23 units. Sold that property in the past year or so for $2.3 million, somewhere around $100,000 per unit. Now, that was a little ways back, definitely a C-class asset, but would it be fair to say that I got a decent lift on that product? That's a massive amount of appreciation. How did we achieve that? Was it because we put in a lot of money? No. But when the entire market goes up, we benefit from that too in secondary and tertiary markets. Same thing whether it was in Sarnia or other markets that we've been in. In Gary, Indiana, one of the worst markets in the US. I'll show you some pictures of that one in a second. We were able to buy a property for $18,600,000. We put in about $4.4 million in CapEx. Our total cost basis was around $24 million. Sold that property just over 2.5 years later for $34 million. How do we do that in one of the worst markets in the country? By forcing rents higher. that is something that's going to work for us every time, because that income that comes in allows us to be able to get a good refinancing cash out, or other investors are interested if they're chasing yield. So that's my focus, as opposed to looking for appreciation and market selection. So that's one of the kind of distinctions. So coming back here for a second, this property here, I like these markets that are a little tougher because of the fact that I have more lift that I can force there. That's my preference. So what do those properties look like? Well, here's the one in Miller Beach. See, notice how I put Miller Beach on here? Miller Beach is a part of Gary, Indiana. It just doesn't sell nearly as well. This is an example of what this looks like. This is just 3-story walk-ups. There were a couple 5-story buildings, mid-rises on this property, 680 units across 20 acres, really spread out. There's nothing special about this. And these are the nice pictures, so we went over this last night, looked at a couple of interesting factors.
Ray, do you do like the teenagers? Do you put filters on the pictures? Is that what you're doing right there?
I think yes, we got all the marketing pictures for this particular market. Looks very nice, right? I'll highlight a couple of things. You can only make these pools look so good. You got to put the nice playground above it. Not exactly an amazing playground structure. Did we put it in? Yes. Is it helpful and a good amenity for families? Yes. We needed to put something new in, because look at this. Like, these courts do not look great. It would have been a good idea to fix the mesh on the basketball net here if we could have. This is a tough market and a tough area, and it was great. And I genuinely wish we could have stayed in that property, but we couldn't, because when the market goes up as much as it did, and now all of a sudden the property doesn't cash flow when it's fully financed, who's buying this? Someone who is speculating on the future value of this property. And I'm just not a speculator. So we had to sell the property. From a risk perspective, it put us in a better position to sell that about a year and a half ago, and then be able to sit in cash. And now we're re-entering the market. I don't advocate for trying to time highs and lows. That's not my objective. But I think all of us with a certain degree of common sense could figure out that the market was not going to be able to continue to support those price points with interest rates being so low. We knew something was going to happen. So rather than putting ourselves in a situation where we're going to have to refinance a year out in a very tough environment, which we thought could be coming and did, we elected to sell and then go ahead and we want to reinvest. Normally we want to refinance properties, pull equity out and reinvest. But in this case, it just made sense to get rid of it. So you'll come back to this, store these pictures in your memory bank, because this is the kind of stuff that I'm talking about. You may want to buy better product, and there is stuff out there. This certainly is at the high end of the product that we buy. This is back up in Clinton Township. And I'm not gonna be upset about buying better product, but why we're buying this is because of an intense motivation from the seller. The seller is out of the country. There was a warrant out for this particular seller's arrest. It wasn't because they did anything wrong, other than they were out of the country. They had blight issues that were coming up, code issues that weren't being addressed because they weren't there. And guess what? Third-party property management wasn't able to support them. Imagine that. So these are some of the things that we need to talk about in more detail, because if you want to get into property management, I haven't seen what's in the chat box already, but management, third-party management, is one of the biggest obstacles. And it forced this seller into a very motivated position because they had to deal with this property while he was out of the country. So they sold it to us because we put in an offer that we could close in 30 days in a very challenging market to find financing. And we did a good job on this one. So that gives you a bit of an idea on the background behind the property. So when I show you these numbers, understand what they look like. These are not A-class properties. These are properties that need some work. There's some lift, and there's a lot of management play on this one. Patrick or JG, any questions or things that I'm missing so far?
Nothing that jumps out.
Yep, okay. No questions so far. I think since I said that thing about the spreadsheet, everybody wants to get to the spreadsheet. That's what I think is happening here, Ray.
Exactly.
So let's get to it. And now that you talked about buying property from people that are out that has a warrant out for their arrest, I think you got a couple people scared too. So a couple people interested, a couple people scared.
And look, this is not always for everyone. And I think it's important to understand we want to try and help solve people's problems. And a lot of people get into this and they have no experience. Some of them have lots of money. We know lots of people like that. They've got money. They get into these types of projects, but don't know how to handle it. And then things fall apart. So we'll talk a little bit later about pitfalls, but let's look at the spreadsheet here for a minute and see where the value is in buying a property like this. You'll see on the sheet here that we're talking about, these numbers are the numbers that the bank gave us. We provided our pro forma, and those of you who've gone for financing, usually the bank will come back and they'll give you their pro forma, which tends to be a bit more conservative than ours. That's usually how it goes. But because of the fact that I'm paranoid and I am a control freak, I like to know what my worst case scenario is. So what I'm going to share with you is the difference between my pro forma and what the bank put in. And I want you to see how those two things differ and how I think you might want to approach your analysis. So a couple very basic things that we can talk about here. Number one is you can see that the property, initially we've got rents in these areas. These are the numbers that the bank put in that they figured we would get right out of the gate. Our numbers were a little bit lower. So there's income and then expenses. I'm going to try and keep this at a high level. If we scroll down on the expense line, we're going to see that our operating expenses, this is where the bank had our operating expenses for the first year, and our total NOI. You can also look at these percentages, the income to expense ratio as a guideline. Well, they have this down near 45%. Well, that's not bad. That's where we expect to be when we're stabilized. Maybe we can get down to 42. That's great. If you're doing analysis on projects or you're looking to work with partners who are showing you expense ratios that are under 40, I don't know how they do it. I sure hope it's an A-class property and somehow magically they get great tenants who don't ever do any damage. Like there's cost associated with property turns.
Ray, so sorry to interrupt, Ray, but I think it's important to to shine a light on this. Is that if you're doing a multifamily, you're going to the bank with a multifamily, and banks will look at this operating expenses. You're at 45.5%. I mean, if they see, they even question stuff under 50% because they automatically kind of put a 50% number on multifamily. That's their world,
Absolutely.
and so, if you come in at, 41%, they're going, yeah, we're going to call BS, so because they just, you got to be really, really aware of that. They do that based on experience, right?
That's a great point, because when we go to the bank, if you're coming in at 40% and you've got a great deal and you've gone out because maybe you're raising money, maybe you're working with partners and you've set expectations at a certain loan to value, they're just going to look at this and go, I think we'll hold an interest reserve, and that's going to take a good portion of your capital away, which has a major impact on your leverage returns. So now you got to go back to investors and talk about the fact that there's a substantial difference. It's a great point. Let me show you what we did. It's a great segue into how we do our analysis. I'll pull up our internal sheet.
Now,
and let's do the same thing. Yeah.
Sorry to jump in, but you just introduced a new term, and for those who don't know, you talked about an interest reserve. Can you speak to that? What is that? What does that mean?
Good catch.
Absolutely. So especially in this environment, banks are still happy to lend. They got to make money, but one easy way that they're able to ensure that they make it through the tough time, the storm that might be ahead, is they take an interest reserve. So in our case, on this property, they took it 1 year's worth of interest on the property. So basically, if I didn't make one payment, they can carry it for that year, and then that gives them time either to liquidate it if I can't manage the property. Like, they're just covering their butts on the back end. And it reduces the amount of proceeds that we're given out of the total sale price. So it reduces our loan to value. What happens when we have a lower loan to value? Lower overall leveraged returns. So we don't like it, but right now that's one thing that banks are doing to mitigate the risk of the current environment. So very important to pay attention to. And this comes into sort of terms and financing. And I think we may end up spending some more time doing a more in-depth look into this as we go along. But as in terms of definition, does that work, JG? Excellent.
Okay, so Ray, I'm going to interrupt you again because I think this is I think it's just an important point and something we want to unpack. As people look at multifamily deals, perhaps, and I'm asking you this question. So if you're going in and looking at a deal and somebody's presenting a deal, maybe it's a listing or maybe it's whatever. You've came across this deal. You get you get statements, and you're looking at these statements. And if you're seeing an operating cost of, where they're, let's say they are 40% or 37%, that should be a flag right off the bat, right? On the other side of that, I'm sure you look at it, and if you look at the real numbers and you go, this is more like 63%, and we have lots of room for improvement, there's where the gold lives, right? If they're stepping over that opportunity, the current owners are not really paying attention to that math. There's an opportunity there to manage operating costs better, bring those costs down. And of course, there's where some forced appreciation lives right there.
Absolutely. Such a great point. And new investors, if you make a mistake on a large asset, it's going to cost a lot. But new investors look at it and go, oh, the math works. Until you get in there and do your due diligence, it's critically important. I mean, this particular property is only 326 units. The previous one was 680 units. How do you walk every single unit? Some won't do that. In fact, most of the inspectors that come out when they do a building condition report or a building condition assessment, they're only going to pick a sample of those units. How do you know which units to pick? They're clues that we can kind of get into minutia on which particular units you're selecting based on how long residents have been there, taking a look at the rent roll and understanding where their accounts are at. You can kind of tell from looking at numbers which units you want to go and see. You never let the seller present those. So lots of things that we can do for better due diligence to understand how much of the truth we're getting, because we're never getting the truth, right? People are going to obviously misrepresent this. They're going to present it in the best possible light because they're trying to get the best value for their property. Can't really blame them for that, right?
Nope.
So on this particular one, you'll notice that our numbers internally are lower on the income side. Instead of being 1,050, we're down at 990. That's a $60 difference per unit. And the other numbers here, we'll come back and do a toggle back and forth in terms of comparison. But the big numbers that you want to pay attention to are going to be the rental numbers for income versus the expense numbers. Now, you hit this number right on the head, Patrick. Look where we are. We're not at 45 in our projections. Our projections are at 55. This is where we perform it at. It doesn't perform nearly as well as what the bank was even willing to accept. Now, for me, I'd rather be in a position where I underpromise and overdeliver. Do I think we can do better than that? Of course I do. But wouldn't it be nice for the first year or so as we stabilize this property not to be under that pressure, to do the best we can? And if we outperform, which I suspect that we will, that'll feel nice to all of the investors that work with us. Now, will we get the number down each year subsequently into those mid to low 40s? Yes, it's very realistic to do that. But this also accounts for a $2.5 million CapEx budget. So in addition to all the operating costs, we've dedicated $2.5 million to repairs and maintenance. And if we wanted to dig into the line by line item, that R&M on the operating statement won't be nearly as high because we're dedicating more money to capital repairs and deferred maintenance that hasn't been done over the years. So there's a strong justification of why we can get to a very realistic expense ratio. So let's toggle for 1 second. This is our internal. Let's go back to what was used with the bank here. And we see the difference. Look at this. This is where the bank is getting us to.
Wow.
Now, is that realistic? I would never say so. Why would I back myself into that corner? I'm never going to do that.
No.
However, this particular bank worked with us on the deal that we did in Gary, Indiana. And I have to tell you, bankers are like everyone else. They're not particularly special. The guys that we work with are great, but they happen to be from New York. So they saw what we did in Gary, Indiana, and they were just amazed. They think that we're geniuses. We're not. We just work a little bit harder. When they come in, or not necessarily these particular bankers, but other people come in their private jets at the local airport, and we pick them up and take them to this property, they're amazed at what we can do because they're just not used to that environment. They don't want to be there. This isn't where they want to entertain clients. They could care less. We actually go to the property. We were joking on the call beforehand because I lived on site in Gary. I loved it. I have zero problem. If I can't live in the properties that we're at, I'm not saying I want to, or that's where I want to raise my family, right? I'm not saying that. But if I can't live there, it means it's either not clean, safe, And those are two important things. And for our residents, it also has to be affordable. That's what makes this a good business model. But if I can't live there, that's a problem. So when I'm on site, they were so impressed with the work that we did, and we exited that for such a great profit. They were happy to take what we did on the last one as a proof of concept and lend to us with very low expense ratios, high projections on NOI, which gives us a better exit when we have to get out of that short-term bridge financing. Okay. So I'm grateful for those relationships. You do a good job for people, it pays off long term.
Yes,
But
and I want to keep I keep interrupting you, but I think it's important that we shine a light on a couple of things, Ray. And I was going to say JG, but he probably went for a glass of water like I did. But the point is there you are. I knew you were around. But the point is that I think we need to shine a light on a couple of things around this whole segment that we're doing here. First, folks, what you have to understand, and what I want to point out is that as much as we look at the top line in terms of revenue, whatever that revenue top line is, good news, can we get it up? Yes, of course we want to get it up. But if we come down to the our operating expenses, anything that we can take off those operating expenses that is sustainable is as good, or even in some cases better than worrying about the top line. If you can get that top line, but that's like you are then increasing NOI, which is bringing is improving on your cap rate, which is improving on the value of this. Now, having said this, I think what you hit on is that we're in a high rate environment. We're in this, how do we get cash flow? How do we invest capital? And we can't get financing. It's hard. Getting financing is not easy, by the way. It's not like this is a walk in the park. It's not. It's heavy lifting. But they're not looking at debt service ratios of the individual in terms of what's happening with this building. And we want to go back to that. And depending on what banks you're dealing with, and I don't know what it is like in the US, but if you talk to multifamily investors here in Canada, they're getting some great deals from banks in terms of rates on multifamily real estate. So I think that this is why we wanted to bring this forward, and it was the timing for Ray, coming up and showing up was really, really good, because I think this is so important for people to understand that you do have options outside of the single or even small multis. Like I'm talking duplex, triplex kind of stuff. There's some really great options here that you can tap into in terms of being able to get capital to work. And by the way, easier to attract investors into this environment as well. So that's all I wanted
so
to
many
add.
great points, Patrick, because it's going to be hard to get to them all. But this loan that we achieved right now, this is a non-recourse loan. There's a bad boy carve out, but other than that, there are no guarantors required for this. Non-recourse. So when I can go into the US and get a non-recourse loan, that tells you that the lender, the bank, sees that there is strong evidence that this property is going to be able to be something that they can sell the mortgage on if they have to. They want to securitize this. They don't necessarily want to hang on to it. They want the option to be able to sell this off, package it up. So it's got to be tight. It's got to be attractive. That tells you that our numbers are strong. When their numbers are more aggressive than our numbers, that makes me feel great. And this is the best part of the segue. So we look at these two. Let's look at the overall projected returns based on these two different numbers. So the bank seems to think that we're going to do real well on this. And output, they seem to think that we're going to have cash flow of 29% annually and a 45% average annual return. That's ridiculous, in my opinion. And we would never show that from a sales perspective. And that's why I want to show you our internals. And on the internal side, it is internals. If we do the same thing for our output summary, this is amazing. 8.5% yield and an average annual return of 28%. That's incredible. And when we can show that to investors and we break it down and you can see that our expenses are extremely realistic, I don't know how much more do I want to promise, Patrick? It's going to send red flags, quite frankly. You show these types of returns, if you can't explain it, how do you reasonably say we think we can get 25% annually on existing? This is not development. This is not that high risk, high return stuff. This is the ho-hum stuff that's out there. And this leads to what's extremely exciting about this time. It is right now in the market where people are so afraid that we have an opportunity to get in where people are having challenges and problems. We can solve those problems with quick closings, closing for cash. Our specialty is able to manage these properties. We don't third party the management. We do it ourselves. We get in there, we roll up our sleeves, and we get these things done. So it's really about the return difference. And there's one more thing I will want to highlight as we try and action pack this into 45 minutes. The difference in return. So here's the output summary for ours. If we were to go in and go back to our property, our P&L statement for a second, and we do exactly what Patrick mentioned, and we take our number and we increase just the income. Let's just look at the income, forgetting about the expenses and dropping that. If we take the income and we move it to what the bank was using for their number, and the bank one, I think on this one was 1150. Let's make sure we get it right. Bank numbers, P&L. 1150. We'll change our numbers to 1150. It doesn't look like much, you know, $60, $70 a difference. Patrick highlighted this last night. It's absolutely a huge difference.
Huge.
So you remember what we showed, 8.5% and 28% returns. If that's all we did is use the bank's numbers on income, forgetting about expenses, look what happens to the numbers. This is not something we're ever going to predict or promise to our investors. 21% cash flow on a property, it's completely unrealistic. But could we get somewhere in between on those numbers? Yes. If you're looking at raising funds and you're working with investors, friends and family, accredited investors, doing everything right, there's a lot of people making mistakes about raising money out there. JG and Patrick know this very well, how to do it properly. You do not want to have problems on that front like many people are having. So definitely talk to them in the breakout sessions they do on fundraising. But for us, when I'm going out and working with investors, how do I want to promise these types of returns? If I promise an 8.5% yield and we hit 10%, they're going to be ecstatic. If I promise 21% and we hit 12, they're not going to be happy. So it doesn't make sense to use unrealistic numbers. But do I think this is realistic? I think we can get very close to it on a deal like this. That's why. So one of the questions we got last night was, why are we investing in the US? Should I touch on those 3 points, or any more questions about the spreadsheet before I go off here?
I got a couple questions, Ray, that I want to get to here because Patrick's been hogging all the airtime. So, which is Brent Mills asked a great question about cap rates. So, what kind of cap rates are you going into these deals with, and then what kind of cap rate compression are you kind of targeting on the way out?
Yeah, so that's a great question. And what we can do is we can actually pull that up. That's a great question for someone who's obviously got some experience with this. What I'm using in terms of my cap rate is on this deal, we're seeing that our number, when we're looking at our refinance, we're looking at 6.3 on our exit. Is that high?
You're going in at 8 and you're going out at 6.3 on the refi.
Well, the 8, that's actually the 8s that are there on the way in. That's typically what we're buying it at that price. But we know when we go to refinance the property, we're going to be able to jump down to about 6.3. And this is really important. What you'll see here, and it's hard to explain, but you'll notice in these 3 years, this is when we refinance the property. After the first 3, we're going to use interest only for 3 years. There's so much great debt product in the US. And then we're going to jump into principal and interest in the following years. So when you look at the debt service coverage ratio, you guys know the numbers. The magic number, make it work, somewhere between 1.2 and 1.25. So when we're using a 6.3% cap rate, we know there's going to be enough income and to be able to support the debt service, not just on the interest, but on the principal. And this, by the way, we're using a 6.5% interest rate on the way out in 3 years from now. Is that going to be a high rate? I think that we've got a great buffer in there. On the way in, we're using about 12%. I am so conservative when I look at making these projections because it's one of the reasons why I haven't bought anything in the past 5 years. And people would say, well, why wouldn't you do that? We can see how much margin there is in this property. I need to make sure that I make successful deals happen. The reason why Patrick and I are friends and JG and I have become friends is because I haven't had a lot of mistakes. These guys don't have people that are coming on who've had deals blow up and all kinds of bad things happen to them. I can't afford that. My investors are the lifeblood of my asset management company. I need to make sure that we make money every single time. You can appreciate that. Between them and the residents, who are also the other end of the spectrum, they are our most valuable customers on the other side. We service those two parties, but we have to make sure we hit results. Why would I take a risk buying a property 2 years ago when I'm buying it at a 4% cap rate, then interest rates go up and I can't support this property on the income and I get washed out? It's not a risk I'm prepared to take. So that's why I've stayed out of the market.
Two more questions, Ray. I love where this is going. First one is, you talked about, and I snuck it on your spreadsheet there. You didn't say it, but I seen it, and I think it's worth mentioning. You talked about seller finance. You didn't talk about it. I seen seller financing on your spreadsheet, which means there's probably a VTB tied to this deal. Maybe you can speak to that, because these big multifamily deals, a lot of people know these things trade hands privately. They don't go through the market most often. I mean, so how does this happen? I mean, you're obviously getting sweetheart deals here.
Yeah, I love that you saw that. There's a lot to try and talk about even on one deal. I didn't mention this before last night, but somehow you saw it. This stuff is fantastic. So the seller on this deal held $5.9 million worth of equity. That's not the same as debt. And as a result, the banks will allow that to work. Fully disclosed to the bank, they held $5.9 million worth of equity at closing. So we worked with the seller to find a creative structure that would work for them, but that also helped us to be able to get a great price. Now, I can't tell you what the seller's motivations would be, but you guys might piece this together. If the seller has equity, one, they're able to defer their taxes. Two, when they sell, they're selling equities, not real estate. There's a different treatment on that. There's a different withholding. If this person is not in the country, I don't know. You know what I'm saying? So there's structures. It's not my job to worry about that. My job is to make sure that when they propose a structure, that we make sure that we disclose it to the bank. It's disclosed, obviously, to our lawyers and the other lawyers. I get my advice, and we put together very creative deals. So it's not just buying a property. It's understanding how to finance these deals in a way where we can get more leverage, which increases our overall returns. And it's the key to this. It's not just the deal itself. It's definitely the financing structure.
I love it. That's great.
I want to add something here, JG. I know that you're giving me a hard time for stealing the airtime, but I'm excited about this for a couple of reasons. But I want to point something out here. You know, Ray.
I still have one more question. I just got to put that on record. I still got one more question.
Okay. You're on record. You're on record. I always come from an education point of view that I want to shine a light on a couple things, and not the least of which is that as Ray made a very, clear statement. I didn't do anything I was out for 5 years, and regardless of why he was out or why he would have been in, it doesn't matter. The point that I want to shine a light on here is Ray had a strategy. He had a thesis, he had a strategy, and he executed on the strategy. And when we look at real estate markets, you probably recall, JG and I've said this many, many times, there are no bad real estate markets. There's just the wrong strategy in that particular market. Now, given what Ray had in mind, what his overarching strategy was, he stuck to his guns. He had a plan, he had a strategy, and he executed on the strategy. That's it. He looked at it. He wasn't chasing deals. He wasn't chasing money. He looked at his strategy. He focused on his investors, and this is what he executed on. And I think regardless of whether you agree with it or not, that's not the point. The point is that's what he did, and that's what works. And it would encourage everybody here to kind of adopt that, to say, okay, this is my strategy, and I'm going to execute with a plan on that strategy. So I just wanted to shine a light on that. So JG, go ahead with your question.
No, let me lean into that if you don't mind, because it's such a critical point. That was not easy. Right? Mm-hmm. I've got investors who sat with us. So we were selling property over the past 5 years. We sold property about starting 2.5 years ago till about a year ago. We just looked at all the markets we were in and felt this was a great opportunity to be able to cash out and prepare ourselves for future opportunities. Mm-hmm. And I was chasing deals, but none of them penciled out like this. Okay. They weren't even close. They were too thin. And so exactly as Patrick is saying, we have a strategy. We want to make sure there's enough margin so that we don't end up in a situation where we lose money. And I have to tell you something. My investors, I genuinely feel a strong kinship towards them. Many are friends and family that I've worked with over years. but they trusted me to sit in cash for 2 years while everyone else is out there doing developments and all these great deals. And we're sitting in cash making zero. And they didn't pull capital. I am genuinely grateful to those people. And it tells me that they believed in the strategy. Just to put it into context, if we bought 12 months ago and we put down 30% and the market dropped 30%, which it has in this environment, what would that have done to our equity position?
Flattened it
We're
out.
down 100% on our money. Like, that's terrible. Now, if you buy it right and it cash flows, you can weather that storm and get out. But if we bought it thin and we in the expense ratios, we didn't pay attention to that, and we weren't using the right stress testing on our interest rates, now all of a sudden we put ourselves in a position where we're doing cash calls or we're losing the asset, we forced to sell, and we're out of business. That's not something I was prepared to do, and our investors understood we're better off to sacrifice a little bit of gain to not, because we're using leverage, we don't want to sacrifice our capital stack. So that's why we stayed out. And when you see these types of deals, they eventually come around. There will eventually be sellers who are motivated to work with us. So definitely hold to your guns. You've been shown a strategy that you're working with through all the education with Rain. Stay with it. Stick to your guns. Don't follow all these people who are running off the ledge. That's a huge point, Patrick.
Yeah.
Now,
JG, go with your question.
Thank you, Patrick. Thank you. So, last question for me is another thing you said, Ray. I didn't see this on the spreadsheet, but I heard you say it. Is, are you playing a little bit of a capex arbitrage where you have a higher R&M, repairs and maintenance, and you're throwing all that into capex as part of the initial contribution, lowering your R&M, increasing your NOI, thus increasing your value over the long term? Is that part of your strategy there?
Yeah, I mean, how do we talk about all this and really make it digestible for people who are maybe new to it? But absolutely. I mean, in a nutshell, what we're talking about here is if I can reduce my operating expenses by using by using capital expenses, what will that do? It boosts income. When do I want to do that? Typically in the first 2 to 3 years, if we're doing a cost segregation study, which allows us to do advanced depreciation so that we can get the best tax benefits for that, but also funneling a lot of our expense into the operating budget. So there's ways to move things from different budgets, but there's consequences. If we move it into capital expenses, because some of it's capital expense, it can go either way, whichever bucket we put it in. But if we put it in as a capital expense, we don't get the tax benefits. So it's critically important that you work with a tax specialist to be able to do some strategic planning ahead of time. There's a lot that goes into this stuff. Some people just jump in. Good thing that you're here. You got great support with Patrick and JG. I'm looking forward to a couple of the upcoming events that they've got putting on, because there's much more detail that we got to get into on the tax management side of things. It's huge.
I'll ask Brent's question here, and then we can you can wrap up here, Ray. Which is from the perspective of an instructor, how can a smaller investor follow in your footsteps, Ray? Not realistic that each and everybody can kind of set themselves up in a different country, and so on and so forth. So what are your thoughts on that?
So as somebody who worked their way into this, I started, 20 years ago. I was a young man coming out of seminary and just didn't have any way to really generate some money. So when I started, the very first property that I bought was a small sixplex in Gravenhurst, Ontario. That's where I started. And it was a great opportunity. And that seller held 100% of the financing and gave me cash at close to do some capital repairs in the property. Why would he do that? Motivation was they didn't want to deal with this anymore. The market was not hot by any stretch of the imagination, and they were able to get me to come in, fresh blood and energy, do all the work. If I didn't pay them and we put the money into the property, have we improved the value? Yes, he wasn't a dummy. He understood that we would increase the value of the property. If we didn't do it, he'd get a property in better condition. He worked with me, and I'll ever be grateful to that guy. His name was John. I won't forget. He gave me a chance. Right now, it's in tough economic times where we have opportunities to engage in seller financing, all the different things that Patrick and JG were alluding to earlier. There's tons of opportunity. Is it realistic for a new person to do that? Yes, it is. And I'm terminally optimistic to a fault. Why couldn't you do it? Why was I able to do it and someone else couldn't? I didn't come into this with money. We built this up slowly over time and with realistic and specific goals. You can work your way through this. And I think that's what RAIN is all about. It's what I've done in the past with mentoring and coaching as well. There's a very realistic path. You don't go there overnight, but over the course of 5 years, it's amazing what you can put together. So don't be discouraged. If you want to jump into some smaller properties, do that out of the gate. Can you set up in the US? Yes. Are there some obstacles? Of course there are. Let's get into that in more detail and tackle them one by one. I do know that Patrick has got me in a bit of an armbar for an upcoming session that we can do and get into some more of these sessions, get into some more of this stuff.
Well, I'd be interested, I think you make a, and I know that, guys like Brent are definitely in. JG, and Ray, this is kind of a test the audience. What if we did a multifamily live event? Put in the chat. Would you guys be interested in something like that if we put together a live event multifamily between Ray, JG, and I? We do something. Well, do you guys want to think about it? That's great. Okay.
I thought the chat was broken, Patrick, right up until you asked that question.
Okay. Okay, I'll take that as a yes. Okay, so we got to give that some consideration and see what we can do. Okay, got it. So thanks for that. And more to come on that. Okay, now
if there's interest on it, Patrick, what we can make sure that we do is talk about who's multifamily for, who's it not for. If you're on the edge, what do you need to get into it? Like that kind of specific stuff, we can help people explore that and determine what their next step should be. Maybe it shouldn't be multifamily, but it's easy to do that when we have a bit more time to be able to talk about people's specific situations and get their questions.
I think there's what's interesting about this, and I would be really happy to hear from you guys, but over the years, what I've learned is that when we open these kinds of conversations up to the community and all of a sudden multifamily, and for those of you who, like he showed spreadsheets, Ray walked through some spreadsheet, looked at the math, looked at, kind of how it can work. Don't be surprised if you're staying in the game and if you're staying connected, all of a sudden there's going to be an opportunity that literally shows up for you. Do not be surprised by that. It will almost, I can tell you right now that it wouldn't surprise me a bit if you reached out and said, hey, PF, guess what? This multifamily deal showed up for me, because that's how it works. So I'm just telling you right now, don't be surprised. So anyways, I'll let you finish, Ray.
Ray, what are your final thoughts, Ray? I know we took you way off course, all the great questions, but they were great questions.
Mm-hmm.
It's super helpful to help direct this. I mean, that's how I've always done presentations. It is really helpful. So I think if there are additional questions, or you go home and you think about this a little more, it's the tough questions. Ask those questions, send them into Patrick and JG, and that way they can formulate what we're going to do in terms of an agenda going forward. It's not information. There's tons of information out there. It's how you're going to be able to execute on that. And if we don't deal with your specific concerns and fears, you won't take that next step. And these guys are amazing. I love what we got on earlier on this call, not to blow smoke, but taking that next step, being action takers. There's some simple things that you can implement to get started on this. And once you start on it, you're going to love it, because buying single family homes is awesome for a lot of reasons, but your cost per unit's going to go down in multifamily. Your income per unit's going to go up. And if you're looking for cash flow as you look at a retirement plan, I mean, what else is there? That's my whole way of approaching things. Our investors are looking for yield. They're not interested in making 10x on their money. They wouldn't mind, but my investors are between 55 to 75, generally speaking, and they're looking for regular cash flow. Aren't you? That's what we all want. We want to have that residual form of income. And that's why I like multifamily, and I think you'll love it too.
Ray, epic job, and lots to learn and lots more to come, Patrick. We're just scratching the surface on the opportunities here in multifamily.